And your vision. Hello.
Good afternoon and welcome to the first ever live podcast of the Art of Investing. Now, this is brought to you by IG, the global investing platform. And if you haven't seen us before, let me introduce you to my experts. No, you're not watching an advert for a Saga holiday. It is Mr. Chris C.J. Fellingham.
My name is Chris Fellingham. I've worked in the City of London for over 40 years. I've managed money for insurance companies, pension funds, hedge funds, across all the asset classes. And I am the chairman of this merry band.
Self-appointed, I must admit. And then on to Mark Spice Holden.
As you can tell, I look younger than our chairman. But I too have worked in the markets for about 40 years. My main speciality has been in equity markets and more latterly in multi-asset hedge funds and absolute return funds. Within this little team here, I'm considered a bit of a commodity specialist for my sins. And I've worked for some of the UK's largest institutional and wealth management companies. But for my main sins, I've worked for 5 times now with Chris, CJ, our chairman, and he's always been my boss. One day I'll get ahead of him. And to be clear, from the outset, I am the bull within this team.
He certainly is. My name's Rich McDonald. I worked for Credit Suisse for about 15 years as their head of emerging markets, and then at Brevin Howard for 3 years running money over the financial crisis, which felt like it was a lot longer than 3 years, but also like a PhD in economics. Now, the podcast, I hear you ask, well, we think we've got 2 USPs. What makes us different from all the other podcasts out there? Well, CJ, run us through what is one of those special things about the Art of Investing?
Okay, Rich. We wanted to bring to the marketplace, to our listeners, over 100 years of experience. That's what it adds up to, and it feels like it sometimes. We wanted to help bring to life the investment markets and help people take responsibility for their own financial journeys. Savings is so important to everybody, and we want to encourage people to do that and help them do it. Through IG, we found a brilliant partner to help educate and bring our ideas through to fruition. But we do something else that's very different, Mark.
Yeah, we do a weekly review where we try and concentrate on the main issues around the world that affect asset markets, and in particular, things that might be in your portfolio. So things that affect equities. We try not to dwell on individual stocks, but sometimes we do. We try and pick on the big asset classes like government bonds, credit, and mainly equities, because that makes up the bulk of our portfolio. Now, talking of portfolios, we are also unique because we run a live portfolio week in, week out, that our listeners, our viewers, can see how we debate each single position and how we make changes.
Which is sometimes quite lively.
It is. We have some very healthy debates, let's put it that way. And our listeners can listen and follow us in the show notes afterwards. They can follow the portfolio if they want. They can see each change we make and why we've done it. They can listen to that. And we've been doing it now for 15 weeks. And since that inception, as we call it, 15 weeks later, after many ups and downs and many heated debates, particularly in the last few weeks, we're up about 9%, which we're pretty pleased with. Finally, we're trying to make 10% a year in a 12-month rolling period. So up 9% after 15 weeks, we're very happy with.
So well done, Chairman, I think is what we all say at that stage.
So, yeah, what we try and do, and CJ has had to pull Mark and I off each other at one point because very much a bull versus bear, but that's exactly the kind of discussions you get in funds and ones that we've been part of and have experienced in our life. So just to give you an idea of the usual running order, we start off, Spice gives us a market update, which lasts about 10 minutes in the podcast. But today we've only got 30 minutes to give you an insight into what the podcast is usually like. So we're going to get rid of that. Then the chairman runs us through the portfolio and we discuss any changes we might want to make that week. But we don't have time for that. So we're going to go straight on to my favorite part of the podcast each week. And that is when I get to hear the stories and the wisdom from these two. Sometimes we have a guest, but usually then it's just the three of us going over what we've learned during our time and the experiences that we've been through. So today we're going to switch things up a little bit, gents, because I hear all these great parts of advice that you give, all the glory days that you've enjoyed through the 80s. Today, I want to hear the stories.
You see how he got that in, that little dig, just to make it clear we're old.
I want to hear the stories when things have gone wrong, because our viewers and listeners on this Finimize conference today, they want to hear lessons and the lessons from when things have gone wrong. So, CJ, why don't you kick us off? Tell us about a tricky experience and what you learned from it.
Well, I've got nothing to say after 40 years. Everything's worked. Now, if you believe that, you'll believe anything. I've lost lots of money in my life, but I thought about this question, and I wanted to bring about or talk about one particular episode. It's my worst ever trade, but it came out of my best ever trade. It's an example, as we might say, of dragging defeat from the jaws of victory. It's early 2005. I've got a very large position in 30-year UK government bonds called gilts, and I'm short of those, and I'm very long of 30-year German government bonds, which are called bunds. Okay. So I've got what's called the gilt bund trade on, and some people listening might well have heard of that expression. Total size was over £2 billion.
Sure.
We'd held this position for 18 months, decided to reverse it. We'd made 5% profit. So I'm feeling really great with my life. I'm fantastic. I'm basking in the glory of success. Some of my colleagues asked what I would do next. They reminded me we had no risk positions anymore and clients were paying us to take risk. And so there's pressure on us to have something to talk about. So rather than tell them to go away, I probably use slightly more fruity language than that normally, but rather than tell them to go away, I decided to return to the previous trade that we had on, but put it on in smaller size to show I was actually doing something. So now I've got back on again, short gilts, long bunds. I don't want gilts to go up in price relative to the German bond market. Unfortunately, this position going back on coincided with the start of LDI buying, liability-driven insurance buying of long-dated bonds by pension funds. Now, what do I mean by LDI buying? LDI buying was when pension funds were forced to sell their equities to buy bonds by regulation.
Oh, wow.
So pension funds used to have loads and loads of equities. They sold them all and they bought bonds. I'm sitting here, shorter bonds. Suddenly, wham, up they go. The buying was indiscriminate. It was enormously in size. Suddenly, the long end of the bond market rallied significantly. I was 100 million down and thrown away a significant chunk of my recent outperformance. Now, there are three lessons that I learned from that, and I think I would like to impart to other people. The first one is there's a tendency for everyone to overtrade.
Guilty.
What you've got to learn is to be patient. You don't always have a strong view. You don't always have a great view. So don't put something on, as normally losses come from positions you were lazy about and just put on without any great justification. So the first thing is wait until you really believe in something. Secondly, I know it sounds obvious, but look at the way you trade yourself. Everybody listening to this, and tell me you haven't sometimes just said, I'm sitting there, let's just put a trade on, right? Secondly, choose your entry level well.
Yeah.
What does valuation look like? What is the current sentiment towards that position? In this example I've just used, I've taken it off because it had done so well. I'm suddenly putting it back on at massively expensive valuations. Over time, you learn that if you have a bad idea, you can make money, even if it's a bad idea, if you choose those entry levels correctly. Equally, though, you can lose a lot of money on a good idea because you went into the trade at the wrong levels. How many times have people bought something and felt happy because it's a consensus trade and it's gone wrong? That is precisely what I'm talking about here. So be very careful about your entry level. The final thing, one of the most important things, never get too cocky and confident. Here's me, I'm going around going, oh, I made all this money, everybody thinks I'm a superstar, all my clients think I'm fantastic. Bang! The market is there to take you down a peg or two whenever it senses that people think it's easy.
So true.
So my three things, and things I've had to learn is patience. Only do it when you really feel like it. You've got to coincide that with a good entry level. If it's a crap entry level, don't bother. And finally, be humble. Remember, the market is there to catch you out.
You say this wearing a hat with what have you got on it?
Oh, it's that one. Sorry. FTSE 10,000. I mean, I've been waiting for the FTSE 10,000 for 40 years, obviously. And there's a chance I might get it in my lifetime or even in the next few months. So we've got these caps. I decided to wear it today to conceal the fact that I'm a bald-headed person. But actually, that's what we are really pushing for. So let's hope it happens.
Would it be safe to say on the pod you're more of a UK focused, and our friend here would have the American flag draped around him?
I think it would be fair to say that I'm more of a generalist asset allocator. So I'm looking at how we allocate to the various asset classes. But I have a blind side view with the UK because I'm a value investor. And, you know, if people want to listen to more about how these things are defined, listen to our podcast. But I'm a value investor, therefore I like buying cheap things. And I've spent quite a lot of my life, therefore, by the UK equity market. I do buy other things, but I in my own personal portfolio has a lot of UK equities in it.
You weren't so impressed with the cheap wine that Mark bought after the podcast last week.
No, it was very poor, and we won't be making that mistake again.
Right, well, for my story, I'm going to take you back to 2010. Yes, we managed to get through the flash crash. I was still at Brevin Howard, running a slightly larger book because we had survived 2009. And everything was going well. You were starting to put risk on again. You're starting to feel a lot more comfortable. And I went home one night. And when I say go home, it was about 6 p.m. So, of course, the US wasn't closed. And it was a special night.
Now tell us about it. Are you sure you can do this on a family show?
Oh, I forgot that we were on the show. I had been trying to get a date with this one beautiful woman for about 6 months, right? And she had finally said yes. So I was getting to take out this girl to dinner. And it was about 7 p.m. and we were going into the restaurant, but the restaurant that she really wanted to go to was underground. So there was no signal on the old Blackberries. I thought, it's fine. There's no Fed announcements. There's no news out. It's absolutely fine. So underground, and I made sure, right, I've got to be out by 10 to 9 so I can, get out and check my P&L and everything. Got out, 6 missed calls from the office, 2 text messages from the boss, and I was down $1.1 million. Now, to give you a clue on what kind of P&L that was for me around volatility, average P&L was about 50,000 a day. So you gradually built that up over the month. So you'd want to be up $1 million for the month. Boom. In an hour and a half of being underground, I had lost that much. Of course, it was the flash crash, where in the space of 37 minutes, 7% was wiped off the S&P 500. 37% was wiped off Procter & Gamble of all stocks. And it was just a shit show. So, of course, my boss was raging. We don't know what your risk is. We don't know what your real P&L is. Get into the bloody office now. You've got 10 minutes to get here. Well, I mean, I was 25 minutes away, right? So, of course, I panic and I was, by then, luckily, by the time I actually came out the restaurant,
it bounced back up again.
It bounced back up. And so I looked at it, and to me, it didn't look like that much of an issue, but he was certainly raging. So anyway, I almost lost my job because of it. But the things I learned...
Lesson, yeah. What are the lessons? Never cancel the whole date.
Never cancel a date. Never go to an underground restaurant. But thankfully, the market bounced, and I was up 1.1 million the next day. So we'd actually net made 100,000 from it. But that wasn't the lesson. The lesson was always understand what risk you are running. Understand the downside that could appear from your portfolio, because you could literally go underground or in on holiday or something like that, and a 7% move isn't that uncommon nowadays. No. If you think of the last 12 months, you've had the Japanese carry trade, you've had DeepSeek weekend, and then you've had, of course, tariff reaction.
And 10-10 in the crypto world.
And, yeah.
I mean, that's volatility for you.
Absolutely.
And wipes you out. So know what your downside is. Protect yourself if you can, whether that is having a diversified portfolio, which I know you have your feelings on, Spice, or learning options and getting your head around the options market. But most of all, be disciplined. And If you are going on holiday, then I now every single time reduce my book or have some
reduce
kind
it
of
or take
hedge.
it all off, because a lot of traders take all their positions off. Do you take them all off, or do you just take an element off?
There was another time I should have learned my lesson. This was in 2007 when BAE Systems got accused of fraud and corruption with the Middle East. I was on the Isle of Skye and I was on there for one night, and the news story came out and I was short puts in the options world, which meant I was long stock. And yet again, I got clumped and my boss actually stopped me out of that one. So I now take everything off when I go on holiday.
Okay.
Yeah.
So just a very quick side thing there that you talked about. You mentioned the BlackBerry, and I just wanted to make it clear that some people on, who are taking part in this podcast had BlackBerry. Before that, it was Reuters pager, if you remember.
Oh yeah, pages.
So we had the little pager, which actually it came across the screen, gilts trading at, and you had to wait, and then it came through.
Oh, wow.
Or equities trading, whatever.
Like a
And before
teletext.
that, you had nothing.
Well, I had smoke signals. And
Yeah. So it's easy these days. You've got it all on the phone. You
Yeah.
can do everything.
The trouble with that is you become obsessed with it, though, isn't it? Because you can't get away from it. It's 24/7, and markets trade 24/7.
Yep.
Apart from obviously at the weekend. But crypto now trades the whole time, which is very dangerous, as unfortunately I'm sure many of our listeners know, and we know as well.
And so what we've been waiting for with the portfolio, we've got about 17% at the moment sitting in short-term gilts or cash, as good as, because we're waiting for a sell-off just in case something happens. So that's something I always usually do in my own savings and wealth management as well, is just in case we get that real horrible move down, I've got a little bit of cash that I can then put in. Because the final thing I'd like people to think about is visualize that happening before it happens, right? I used to do athletics. I ran for Scotland in the Commonwealth Games back in Manchester. And you used to always be so prepared for a race that you knew every single hurdle that was coming before the gun went. And you knew how you were going to run it. So I apply the same discipline to my portfolio, right? I imagine, right, what if we get China moves into Taiwan this weekend, right? What's the market? What do I expect the market to do? And what would my reaction to it be? So hopefully it never happens, but just in case it does, I've got some kind of idea to put into action and not be a rabbit in the headlights.
So I'm just going to challenge you very slightly there, because whilst I agree you need some, we do need to remember, for the benefit of everybody, that actually over any period, any 25-year period, as we were talking about the other day, the Deutsche Research Institute did a wonderful paper. For anybody who hasn't read it, it's a fantastic document on asset returns. And basically, over any 25-year period, equities win hands down over everything, including cash and everything else. So hold a bit of cash, yes, but not too much cash, because you want, as a saver, to get that capital appreciation over time and drive your wealth forward.
Spice, before you asked, no, I didn't get a second date. But do tell us your story.
So yeah, I mean, okay. So in this in our portfolio that we run for the podcast, we don't own individual shares, and thank goodness we don't, because some of my most scarring memories come from owning individual shares back in the late 90s and the 90s and the early 2000s. I was a UK equity fund manager, and I was working with Chris for the second time in our career, and it's in 2011, and I was buying a position for one of the first UK unconstrained unit trusts. I was running about 120 million pounds of assets under management, not a great deal of money, frankly, compared to sort of someone like Chris who was running billions.
Yeah.
But I started buying a position in a oil exploration company in the Falkland Islands called Borders and Southern.
Oh no!
And anyone who knows me,
it's making me feel ill just thinking about this now.
Was this when you were his boss?
Yes,
Yeah,
it was.
yeah.
Yes.
Well, I had another two bosses in between.
Unfortunately, I can remember this story. It's etched on my heart. This one.
Not as much as mine, I can tell you. So I started buying this position, and I'm a great believer that actually I don't want to have too many stocks in a portfolio, because actually I make my worst decisions not in the top 10, but in the next 10 or the 10 after that. And actually the unit trust rules force you to have diversification. The rules make you have, you can't have any stock more than 10% of your portfolio. Anything over 5%, if you add it all up, can't become more than 40%. And that forces you to diversify. So the minimum number of stocks you can have is 16, right? But I like going for 10. I like to have concentrated. So I always like about 20 stocks, 25 stocks. Yeah. Anyway, I'm buying a 5% position in this fund, in this Borders and Southern. A very small company. It was an AIM listed company. And I can invest in the whole of the UK. I started buying them about 40 or 50p. And they started rising quickly. They were drilling a prospect called Darwin in the South Atlantic. And as the drilling progressed over the next couple of months, they went to 70p, 80p. And we were coming up to the big moment where everyone sort of knew that we were going to get the results from this drilling campaign. And my fund had gone from sort of median performance, and I was now the number one fund in the UK by a country mile, I might add. Because not only did I have Borders, I had a couple of other sort of fairly linked stocks as well. If that came off, then that would work, and that would work. And there's a lesson there. There's a lesson
another
there.
Example there of hidden exposure
Yes.
with lots of stocks exposed to the same things, but they're not the same stocks, so the compliance people never catch me that way.
Exactly, and that is a very good lesson I learned, because when one goes wrong, the chain reaction is enormous.
A bit like artificial intelligence.
Why do you say that? That's another debate. We haven't got time for that one. Anyway, so I'm number one fund. We're on an offsite.
Now, hold on. Let's just set the scene here. I've organised this offsite. I was the chief investment officer. We played golf, getting everybody to play, Texas Scramble. So everybody had to play. Even if you could not play golf, you could still contribute with a putter on Texas Scramble. Everybody had to play. In the evening, I took a look at what happened in the market, and this stock was now trading sort of £1.20, and it was massive. We'd started off with a 5% holding. We now got well over 10. So I called an impromptu meeting with the chief executive, me, the CIO of equities, and young Mark over there. And we said, we've got to review this position because it's done so well. Yeah. We need to take a bit of profit out of this. Yeah. I'm going to pass that conversation back now because I don't want to remember any more of what happened that night.
Largely, it's eradicated from my mind too, actually, because this is a Friday afternoon, and I had a big position, and I thought, no, I'll talk to it. We were talking, and I said, look, all the feedback, all the rumors, everything that goes with equity investing was that they were going to make a discovery, and the shares. We decided with my head of equities that we would run it over the weekend into the announcement. Sure enough,
against the advice of the CIO and the CEO.
It was a sort of 50-50, but to be fair, you had more power. I only wish you'd made me do it, but there we go. That's another story.
Oh, that's my fault now. I think that's gaslighting, is it?
Come on, Chairman.
So anyway, gosh, but sure enough, Monday morning, I'm really excited. I'm in the office early. The announcement comes up. They have discovered gas condensate. Now, they were drilling for oil. Now, for those of you who don't know, gas condensate is a very, very light form of oil. But this chief executive of that company decided to call it gas condensate rather than light oil. Oh. The stock market didn't want gas. And the shares went straight to £1.38. In fact, they spiked at one point. You couldn't trade it. It hit £1.50 and almost £2 as the excitement about this discovery came. And then people read gas condensate, gas condensate, gas condensate. The next thing you know, the shares were coming back down again. And suddenly my phone lit up on my desk. And I thought, oh, God, I know who this is. Uh-oh. And sure enough, it was the company stockbroker. I had to answer the phone. I said, hi, Spice here. He said, Spice, I want to make you an insider on Borders and Southern.
Ooh, what does that mean?
Well, when you're made an insider, you cannot trade in the shares. That's it. You are made an insider. And the reason is they were trying to raise more money to do some more drilling. So a
rights issue, as it's known,
well, it was,
or the end of the road, as I called it.
Well, the next price, they wanted to raise money at 84p. Remember, they were trading at
£1.30, £1.40.
£1.38, and they wanted to raise money at 84p, which they did. But the shares immediately traded there. The month after that, they were 70p. Then they were 60p. And ultimately, they went to 20p. Oh. And that was the most scarring example of my life. I mean, there's several lessons there. The most important of which is when you buy something for a reason and that reason doesn't happen, be true to yourself, be honest. Don't put your head in the sand. Don't pretend. You have to make a decision. I should have cut the whole position, should have cut completely out because it would have cleared my head. And I've done that. I'm naturally a very good person at getting rid of mistakes. in my portfolio because I like to sleep at night. And, it's like if you own a company, the chief exec resigns and you've bought this company because of the chief exec. It's brilliant. He resigns. I sell my position straight away.
Yeah.
And then I sleep overnight. And then they say, we're going to replace him with our deputy. He's really good. And you go, actually, you know what? He's really good. So I'm happy to then make a decision again. I'm happy to buy them 5 or 10% higher up. But I've cleared my head. I've made a decision. My instinct now is, if you see something change and you think that's important to the share price, sell it.
Shoot first, ask questions later.
Absolutely.
And so I mean, I think that is, if we wanted to bring together just that final point, if there's something that I think you mentioned with yours, I certainly had with mine. When I had this huge loss, I remember going to New York for an offsite, and I was waking up at 3 a.m, trying to deal in the gilt market from New York back to London. And I could only deal in sort of 50 million, and I'm sure $1 billion. It was a pointless waste of time, but it was occupying every inch of headspace I'd got and stopping me doing anything else. So the one thing I would say is, if it psychologically starts to dominate what you're doing, cut your position.
Absolutely.
Take at least some of it. If you can't bring yourself to take it all off, take half of it off. But take it off, and then you can breathe again and make good decisions again. You've got to live to fight another day.
I remember a psychologist coming into us at Credit Suisse, and his advice: if you are praying for the position to go right, it's too late. You got to start cutting that position, because you're looking for an existential, a help, when that's not what
old city expression. Hope is not an investment strategy.
It's very easy with companies and stocks. You can fall in love with them. You can see all the vans, driving around you, and you think, wow, they're doing really well, because I see loads and loads of vans. They're doing really well, and you can easily fall in love with the story. The trouble is, you're just buying a bit of paper. That's all you're doing. It's a share of their earnings going forward, and you've got to clear your head of that sort of emotion and try and become emotionless when you start dealing in stocks and shares. Particularly, I think it's easier when you deal in whole stock markets like exchange traded funds, like buying the FTSE 100 or the S&P 500. That is easier because there's no one individual reason why you might love that or not.
So, gents, that I think rounds up all the lessons into one: is managing your emotions about the money and the size of investment. Chris, would you say that the sizing is really important?
Well, it's the sizing that starts to make you. It starts to dominate your thoughts. If you only buy a little bit, so we've all bought a little bit of something and it goes wrong, and we go, well, I don't really care. It doesn't matter, right? But at the end of the day, we need to be a big enough position to make a difference to our portfolio performance, but not too big as to dominate. So you've got to play around with what suits best. And of course, one of the ways you look to do that is you look at the volatility, the amount of movement up and down. The thing is, that you buy or sell, and the size then of how much you buy. So if you're thinking about Bitcoin, for example, which has got a volatility of 80 to 90%, don't buy a lot of it, because if it does have a bad day, it's going to really hurt you and make you feel upset. So match a bit more your size you're holding to the volatility that things are.
Right, we got a couple of questions coming through. Before that, I will just let you know exactly where you can find us. Every Friday afternoon, we release that weekly podcast. Spice, where can they find it?
You can find it on all the good podcast platforms: Spotify, YouTube, and Apple are the main ones we use. And they all have show notes. They've got links to the portfolio, as I said, with our performance updated weekly.
And a big thanks to IG, of course, because they host our show on their YouTube. So it's the IG UK YouTube. You can find all our previous episodes on there. And on the IG platform, you can find our portfolio in the watch list section.
And that, I think, is really important. One last thing to say. We run that portfolio, as Mark says, on the TV. Transparently, everybody can see what we're doing. There's no hidden good performance or bad performance.
Right, can we fit in a question then? What are the most underrated or under-analyzed investing opportunities during 2026? That could be another half an hour, because you can see these two like to talk. But in one quick answer, CJ Fellingham,
Well, I've got to say the FTSE, haven't I? I mean, look, the cap's here. If the cap fits, wear it. Ka-ching.
Oh, what need I even ask?
I think it's only a matter of time before the smaller and mid-sized companies begin to catch the coattails of the very large Mag 7 and all the mega cap stocks that have done so well in the last couple of years. It's a question of timing. They do well when interest rates are falling and when the underlying economy are doing better. Sadly, after this week's budget, I don't think the UK is in a great position to do that. But in America, they stand a chance. They'll be cutting taxes, one big, great, beautiful bill, stimulating the economy. And there will be falling interest rates there too. So that should help that area of the market.
I thought we got away without mentioning the budget or Rachel Reeves at all. Almost. Well, my most underrated opportunity of the year is for you out there to tune in to The Art of Investing every week, every Friday. We would love to see you there. And we also do a little bit of interaction with viewer questions. Gents, if they've got a question, where should they write in?
The Art of Investing at IG.com.
Thank you very much to Finimize for giving us this platform, and enjoy the rest of your day.
Thank you.